All right, welcome everyone to our 25th Business Breakdowns with Cannara Biotech. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning into this Business Breakdowns conversations with Cannara Biotech CFO Nick Sosiak. Nick, welcome. Thanks for joining us.
Thank you for having me.
My tag team partner for this Business Breakdowns is Matthew Martin. Matthew is a portfolio manager at the Rivmont Microcap Fund and a longtime Microcap Club member. Matthew has been with us since 2015. Matthew, thanks for joining us as well.
Thanks, Adam.
The business we're breaking down today is Cannara Biotech, which trades on the TSX under the symbol LOVE.V, along with the OTC in the US under the symbol LOVFF. Cannara was originally profiled in February by Matthew. Cannara Biotech is a Canadian cannabis company specializing in premium quality cannabis production at affordable prices. Due to its premium high-quality products, Cannara has emerged as one of Quebec's fast-growing licensed producers. Cannara grows their product in state-of-the-art facilities, employing methods used in the most sophisticated markets in the world, cultivated from rare genetics, hang-dried, slow-cured, and hand-trimmed. Today, Cannara is recognized for its craft quality at disruptive pricing and has rapidly carved out market share in Quebec. Cannara is strategically positioned to capitalize on the growing Canadian cannabis market from here. So before we get into the presentation, Nick, it seems like just going over your background, you're kind of a jack of all trades here. So public company experience, accounting, product focus now. Can you just tell us maybe what led to Cannara and what was attractive about the opportunity for you?
Yeah, so by profession, I'm a CPA CA. So previous job was a VP finance for a real estate company. I've been in the public markets, accounting, finance, but my true passion, deep passion within me is cannabis and the plant. And when cannabis legalized in 2017, that really piqued my interest to be able to merge my profession and my passion. And so 2017 to 2019, I was looking for an opportunity to enter the cannabis space. And our founder and CEO, Zohar Krivorot, was starting a business here in Quebec and purchased his first 675,000 square foot facility and was going public for Cannara under the symbol LOVE. And since it was, I'm based out of Quebec, it was an opportunity for me to bring my finance and accounting skills to the company and the public market skills, but really bring also my passion and my vision of how cannabis products should be and branding and all that. So, this led me to here and working with Zohar to really have my hands in every part of the business. And that's what gets me up in the morning. That's what I enjoy. And I don't see myself doing anything different.
Awesome. Yeah, thank you so much for sharing that. That's good background. And we'll get into some more things as we progress here. So with that, I will pass the mic to Nick to go through the presentation. As a reminder to listeners, feel free to post your questions in the Q&A box by clicking on the bottom of the screen. Nick, the floor is yours.
Thank you, Adam, and thank you, Matthew, for having me on the Business Breakdown and giving me the opportunity to present Cannara Biotech. As I'll describe today, Cannara Biotech actually stands out as one of Canada's most profitable cannabis producers. We've delivered market share growth, revenue growth, industry-leading margins, positive operating cash flow, free cash flow, and we have one of the cleanest balance sheets with a manageable debt profile and near industry low interest rates. As I go through my presentation, we'll have general disclosures, which can be found on page 2 and 3 of our investor deck, which is located on our Cannara website at www.cannara.ca. As explained before, my name is Nicholas Sosiak, and I'm the CFO of Cannara. Been here since 2019, and I've had my hands on building everything within this company from the ground up, working across every function from cultivation processing, finance, sales, marketing, product development, you name it, I've had my hands in it. And it's been a personal and professional journey rooted in our shared passion for the plant and the business that we're building. And I also want to recognize our founder and CEO, Zohar Krivorot. While he couldn't join us today, Zohar's led Cannara since day one, founding the company and guiding it from the startup to industry leader. Over the past 5 years, he's also taken on the role as master grower, developing a deep commitment to the craft and playing a key role in shaping the quality and consistency of our genetics and cultivation. And that passion for the plant, the product, and disciplined execution is what's carried us through the volatility of the Canadian cannabis market. We've seen meteoric rises and sharp corrections, but through it all, only a handful of companies actually have consistently grown their revenue, expanded margin, and achieved real profitability. And we believe that Cannara is one of them. And we've done it by staying true to our core: premium product, operational discipline, and full vertical control. Today, I'll walk you through why Cannara is positioned to be a dominant and consistently profitable leader in Canadian cannabis, and present you the strongest financial results in our history. Our Q3 fiscal quarter end, May 31st, 2025, which was just released this past Monday on July 28th. As of May 2025, we are currently the 7th largest LP in Canada by sales and 2nd largest in Quebec, where we built strong brand loyalty. We also rank as the 4th largest producer by square footage nationally and the largest in Quebec with 1.6 million square feet of hybrid indoor space, fully owned and operated. Today, our annualized production run rate is approximately 50,000 kilograms, a milestone we achieved this quarter through extensive R&D and optimization of our cultivation processes. These improvements resulted in a 26% increase in our capacity without any additional capital costs. Our output is currently supported by 12 of our active grow rooms, each measuring 25,000 square feet at Valleyfield facility of its total 24 zone capacity, as well as our 11 smaller grow rooms of 2,000 square feet each at Farnham, which serves primarily as our post-processing and packaging hub. Fully scaled, our 2 facilities have the capacity to deliver up to 100,000 kilograms annually. No acquisitions needed, only internal capital investment. Being fully vertically integrated is a major advantage for us. We control everything in-house from the cultivation all the way to the distribution, allowing us to ensure the quality, drive efficiency, and protect margins in our challenging market. We believe that we built one of the strongest platforms. Nearly every level of our business is evolved beyond the standard cannabis company. We are real operators. We're boots on the ground. We have passion for the plant, and we improve and R&D techniques on a daily basis, from myself on the finance, sales, and marketing side to Zohar and the team on the cultivation and manufacturing side. And the recent increases in our capacity prepares us to really meet the uncaptured demand of our brands, which we will dive in a bit, and to support the Quebec upcoming brand new vape category launch this November. We recently received approval, pending final procedural steps, for 5 of the 25 vape SKUs onboarded by the SQDC, which gives us 20% of the shelf space for this totally brand new category in Quebec. This category, also in our home province, is a significant opportunity, as we are Canada's leader for premium vapes in Canada, with a 23% national market share. Our approach combines rare genetics, high cannabinoid strain profiles, sophisticated cultivation methods like hang drying, hand trimming, and slow curing, all done at scale without the need of irradiation. As you can see on this slide, our profitability isn't just a one-off. It's part of a consistent multi-year trend. We've scaled revenue, grown EBITDA, and improved our margins year over year while maintaining operational discipline. That's what sets Cannara apart. We've been net income positive since fiscal 2021, operating cash flow positive since fiscal 2022, and free cash flow positive since fiscal 2024. As I mentioned earlier, our Q3 2025 was the company's best financial results in its history. For the 9 months of 2025, we posted $80 million in net revenue, with a gross profit of $32.7 million. Revenues are just $2.2 million shy of our 12-month 2024 annual revenues, which we had 27.9 million in gross profit, which we already realized 4.8 million more in gross profit in the 9 months of 2025 compared to the 12 months of 2024. Our gross margin has reached 41% with steady quarter-over-quarter increases as we scale into our improved yields and benefit from our economies of scale. Furthermore, there is a further margin improvement in the future as we onboard more automation equipment and improve efficiencies over our various manufacturing processes. Adjusted EBITDA for our 9 months of fiscal 2025 was 20.7 million, or 26% of revenues, which is already over $5 million compared to our 12-month 2024 adjusted EBITDA. Net income for the same period was 9.8 million compared to 6.4 million in annual 2024 net income, a 53% increase already in the 9 months. From a cash perspective, we've generated 17.2 million in operating cash flow and 12.3 million in free cash flow for the 9 months of 2025 compared to 10.7 million and 3.2 million for the 12 months of 2024. So as you can see, our performance over the last 3 years shows consistency, scalability, and profitable growth, a rare feature in the cannabis sector. At our Q3 quarter end, we held 14.4 million in cash, up 7.8 million from our prior year ending cash balance, and held a working capital position of 49.4 million. We maintain 84 million in current assets against 34.6 million in current liabilities for a current asset ratio of 2.4. At quarter end, we had approximately 91.4 million basic shares outstanding, with less than 1.5 million shares issued over the past 12 months and less than 3.8 million shares issued over the last 3 fiscal years. Basic shares issued over this period were largely as a result of employee stock options with no dilutive capital raises conducted since the issue of our $5 million convertible debenture back in 2021. Cannara has over 50% insider ownership between our CEO and our member on our board of directors, which means that Cannara is led by operators with skin in the game, fully invested in building long-term value alongside our shareholders. As of July 29th, our market cap was 173 million, with a closing price of $1.89, representing 170% year-to-date increase on our stock price. From March to July 2025, we executed on 4 key financial milestones that strengthened our balance sheet. First, we repaid $1 million against our $5.7 million convertible debenture with the LOVE.V, which is maturing March 2028. And a second partial repayment of $2.3 million is due in September, for which we've already secured a replacement convertible debenture with the same terms. Second, we signed a binding LOI for a $5.5 million sale of an unutilized building and its associated land at Valleyfield, which we expect to close next week. In addition, we completed an amendment on our existing credit agreement with BMO, a leading Canadian bank, reducing our interest rate on our $34 million term loan and $10 million line of credit maturing December 2027 by 75 basis points, reducing our overall cost of debt below 6%. And finally, we achieved financial covenants that allowed us to remove a limited recourse guarantee with BMO on our credit facility, saving $375,000 in annual interest expenses. So we stand strong by saying Cannara maintains one of the cleanest balance sheets in Canadian cannabis, with ample cash flow and to fund our expansion strategy and to service our debt position, and we have no significant long-term maturities until December of 2027. Our market share continues to outpace our peers, driven by premium quality cannabis at affordable prices. This is made possible by our low-cost operations, scaling efficiencies, and access to Quebec's low electricity cost. As of June 2025, we hold a 12.6% market share in Quebec, up from 9.7% last year, a 30% increase. In March alone, we gained 60 basis points, while the number 2 LP lost 80 basis points. We are now just 60 basis points from being number 1 in Quebec. This is especially significant because in Quebec, and sometimes overlooked by investors, is that Quebec is the only province where almost no promotional activity is permitted. With no sales and marketing levers, growth really reflects product quality alone, a key signal on our ability to win across Canada. Nationally, we're the 7th largest LP with 3.8% market share, up from 3.1% last year. That's a 27% increase year over year, making us one of the fastest LPs in the country. Looking at our CPG portfolio, some of our successes include we offer one of the fastest growing premium infused pre-roll multi-packs in Canada. From March to June, we grew our category share by 12% to 8.5% of the category share, while the number one competitor declined, now ranking number 2 in Canada and number 1 in Quebec. In Quebec, we also hold a commanding 70% share of the infused pre-roll market, which makes Nugs the undisputed leader in the province. For premium vapes, we hold over 23% of the national share, with sales up nearly over 70% year over year, despite being one of the highest priced product lines in the category. And this confirms our ability to not win just on price, but on quality. And that same vape performance, we believe, will give us extremely strong positioning ahead of Quebec's vape launch this November. Tribal leads the premium 3.5 gram flower segment nationally, now holding over 18% category share, with pricing at $30 in Ontario, which is a disruptive value versus ultra premium offerings at $50, where you get similar or less quality than Tribal. As just shown, our brands are winning in some of the most competitive categories in Canada. From infused pre-rolls to live resin to vapes to dried flower, that performance really reflects a clear brand strategy executed with real operational discipline. Tribal, our main brand, is our flagship house of genetic brand, built around exclusive cultivars, high THC flower, and premium extracts. Thanks to our Canadian exclusive partnership with Exotic Genetics, Tribal brings proprietary genetics, giving us a unique edge in both dried flower and live resin products. Nugs is our format-first, trend-driven brand. It thrives in fast-moving categories like bulk flower and infused pre-rolls. Nugs delivers premium quality at accessible prices by leveraging exclusive high-yielding genetics, excess Tribal inventory, and full in-house manufacturing. Orchid CBD is designed for those looking beyond high THC and more for a balanced, terpene-rich, full-spectrum experience. Leading the way for Orchid is our CBD Runts, holding title as Canada's #1 CBD flower. Our market share success is built on the strong inherent competitive advantages present within our asset base. We operate 2 state-of-the-art mega facilities in Quebec, enabling full vertical integration across all our processes, without the need for third-party cultivation, extraction, or manufacturing. Our Farnham facility is dedicated to the operation of our nursery, our pheno hunt process, post-harvest, and packaging. The facility is 650,000 square feet, of which we occupy 200,000 square feet, and the balance of the building is currently leased out to long-term tenants that generate over $4 million in annual rental income. Our Valleyfield facility is a particularly significant asset. It is one of the largest cannabis facilities in the country and the largest in Quebec. We acquired this facility in 2021 for just $27 million. This was an extraordinary opportunity, considering the incredibly over-engineered facility was built during the overspending gold rush period of Canada's initial legalization, and the facility's original construction cost exceeded $250 million. This acquisition, at a fraction of its value, has given us leading access to one of the best cultivation facilities in Canada, with mass scale and low-cost cultivation. 12 of their 24 rooms are now fully built out and operational, up from 10 rooms in fiscal Q2. The new active rooms 11 and 12, after our breakthrough in cultivation improvements, will allow us to increase our capacity to annual yields of 50,000 kilograms, representing a 50% increase year over year. Activating the 2 additional rooms required a capital investment of $1.5 million, which will allow these rooms to generate over $10 million each of annual net revenue, and at our current average selling price, returning this investment well within the first year of operation. We view our ability to turn on online additional cultivation capacity with very minimal capital outlay while generating immediate, incredible, strong returns on invested capital as an incredible competitive advantage present within our asset base. For 2026, we will initiate the first phase of construction on our dedicated processing center at Valleyfield to support additional drying, trimming, and post-harvest capabilities. This $10 million investment will unlock the capacity to activate 9 additional grow zones, providing a clear pathway for continued scalable growth. What sets Cannara apart is our ability to activate capacity within our fully vertically integrated structure in lockstep with demand, delivering best-in-class return on investments thanks to our minimal capital required to bring new grow rooms online. And it is important to note the benefit of having each expansion project occurring within the same facility, within the same team, the same SOPs, and same systems, driving significant operating efficiencies, margin scalability, and most importantly, consistency as we grow. As we transition from operational milestones just discussed, this slide highlights the financial outcomes of that disciplined scaling strategy. Over the past many quarters, we've delivered a clear, sustained growth trajectory, with net cannabis revenue tripling and gross profit before fair value adjustments reaching record levels. Gross margin has continued to expand, now at 44%, demonstrating the impact of scale, operational vigor, and a tightly managed cost structure. Rather than chasing growth through external acquisitions or greenfield builds, we've remained focused on high-quality, internally driven expansion that translates directly into shareholder value. But why are we succeeding and others not, you may ask? On top of our laser-focused strategy and prized assets, we have Quebec. Quebec has been and always will be part of our secret sauce. It's becoming clear that licensed producers coming out of Quebec are emerging as profitable leaders. As Canada's second largest province with over 9 million people, Quebec provides us with a home field advantage and access to some of the lowest utility and labor costs in Canada. One of the most compelling benefits is that the province's exceptionally low electricity rate at just 5.9 cents a kilowatt, substantially lower than those in other provinces such as Alberta, where rates are as high as 14 cents a kilowatt. Since electricity and labor account for over 75% of indoor cultivation expenses, our Quebec positions us to give a significant competitive advantage within our cost base and enables us our ability to be disruptive with our pricing while still generating industry-leading margins and cash flow generation. Beyond low electricity cost, Quebec presents the highest barriers of entry, particularly with strict restrictions on sales and marketing. These combined factors, combined with the lack of retail data deals, makes Quebec an ideal environment for Cannara's growth. While many Canadian LPs are expanding overseas out of necessity, we are actually thriving in Canada by choice. The reality is that most can't compete profitably here. They're losing market share, struggling to build brands, and failing to operate efficiently. Success in the cannabis industry is not simply rooted in scale, first mover advantage, or capital market access. And the history of overbuilt, overcapitalized companies losing market share to more sophisticated operators with better quality product is a testament to that. Success in this industry is a derivative of experience, knowledge, and most importantly, execution. Cannara has built our success from the ground up with an extremely pragmatic, supremely focused operations team backed by leading commercial strategies and a truly premium product. Thank you again for taking the time to learn more about Cannara, and I'd be happy to open the floor and take your questions.
Excellent. Thank you very much for going through the presentation. That was really comprehensive. We really appreciate it. As a reminder, if you have a question, feel free to post it in the Q&A box by clicking at the bottom of the screen. I will kick things off here. So obviously you guys have been executing well, and this is what we can address some low-hanging fruit here. So this is a heavily regulated industry, and even if you are executing well, there may be some issues with potential investors getting involved in the space. And I'm curious, this has kind of been a multi-year, almost close to a decade theme. What do you think changes moving forward in terms of increasing fund flows, getting more interest from maybe non-retail investors? opening up things on the institutional side. Can we just get your take on that?
It all comes down to execution. I think the industry has been in a bit of a turmoil for because of everything that happened, and the capital that was injected at the beginning of the onset of the industry. So now I think time and execution is required for institutions and investors um, to get excited about these companies again. It's a real industry. It's a growing industry. There's key players that are making that are going to take a big market share of that and going to generate significant cash flow. So institutions and they're going to recognize that very shortly, and I think we're getting there. We're at the tail end of the consolidation. There's still some consolidation to happen, and I think a little bit more time and some more execution on the LPs, including ourselves, will generate the interest back.
Okay, great, thanks. And then, um, as you think about how the industry evolves over time, where do you think, I mean, I think I know your answer to this, but where do you think the best place to be positioned is in terms of across the value chain? So do you think we'll see more brands being developed on the product side? Is it more about getting the right logistics and infrastructure in place for growers? Can you just talk a little bit about kind of how you see things evolving over time?
Yeah, so I think it's going to be hard for new key players to try to make a dent in the top 10. There's hardly any capital coming in, so there's no uh, an investment thesis of growing a cultivation center, brand new cultivation center for a brand new brand and raising X amount of capital to do that. Those days are gone. So I don't think there's going to be a lot of investment in cultivation in the future, which is actually um, where we're lacking right now because of the whole consolidation. There's been a significant amount of cultivation centers that have been shut down, repurposed into non-cannabis cultivation, and then the ones that are still operating, we just created this international market over the past 2 years that we're sending 40, 50, 60 tons of cannabis internationally. So all that volume is going internationally. We closed the supply down. So you know, economics 101, the demand is there and the supply has just fallen off a cliff. So I think where we want to be is we're happy to be vertically integrated. We're happy to not be a licensed producer that is um, relying on another licensed producer for its cultivation, because controlling the cultivation and controlling the quality of products will dictate how your brands are successful in our industry. So we're happy that we're controlling that. We're focused on Canada. We believe the opportunity for us is in Canada to build brands and brands that will stay here for decades to come and create customer loyalty. And then once we own Canada, if we can't build a brand in our own market and own it, how the hell are we going to build a brand in international and own that? Like, it just doesn't make sense to me. So for us is we need to own the brand and control the brand and create this brand to be number one in Canada, and then from there we can leverage that into international US. Like we've owned Canada at that point. So that's our goal. That's our goal. To stay laser focused on that. Scale up as we continue to open demand channels, and the biggest challenge is just sales and marketing and distribution in the rest of Canada, because it's like the CPG. It's more CPG oriented versus Quebec. You have to get distribution space. You have to be in front of your customers, right? So that's part of our strategy, and that's also the last for some LPs that are struggling. That's the last tool that they have in their toolkit to continue increasing revenue, and all that takes is money. So some of them have money and can just push that lever to hold that market share in the rest of Canada. But over time, that's not sustainable. One, they run out of money, or two, the customer realizes that they don't want to be pushed these garbage products and then start moving to other products, right? So that's why we're very diligent, and we're watching and waiting and growing quarter over quarter. But we're not trying to double our growth over quarter to quarter. It's like a a steady, measured approach to market share growth.
Okay, excellent. And last one for me, and then I'll pass it over to Matthew. So what do you think is driving some of that consolidation that you talked about? Like it seems early on in the industry, it was kind of a land grab for market share, both on the retail side and on the grower side. And just it was like expand at all costs kind of thing and dilute, shareholders to do so. And now it seems like as we've played this story out for some time, a lot of companies are now more focused on like growing market share, as you mentioned, or profitability, and maybe like a brand realizes that it's better placed with a distributor that can push it through their system or so to speak. I'm curious, is outside of that, maybe the growth in market share, is there anything in particular to call out about what's driving the consolidation?
So I mean, just the pressures, right? The financial pressures. We're successful because one, we're extremely invested in our business. We bought a $250 million asset for 27 million. If I built a $250 million asset and I had all the interest costs to cover and all that, we wouldn't be operational. So that advantage of having buying that $27 million asset or $250 million asset for 27 million, being in Quebec, where I have the lowest cost of electricity and very favorable labor rates, which is 75% of my cost of cultivation, that allows me to make margin, right, and generate cash flow. If I wasn't with those dynamics, yes, I would be generating revenue, but I would be losing cash flow. And at a point in time, there's so much cash you can lose, and the capital markets are not. Some companies have that access to capital markets. A lot of companies don't. So when they hit that roadblock, there's nothing to do but to close down their shop, right, and go into CCAA and go through that process, and then hopefully a bigger company comes in and scoops them, or they can get out of the process and restart from scratch. But they've reached the tail end of the money bag. Nothing's left in there. So and that's I think there's still some competitors in that frame of mind still have some money left, so they can still execute and be very aggressive in pricing and sales and marketing and distribution. But again, there's going to be a finite runway for that money to keep flowing, and I think give it another year or two, and it's down to just competitors that are generating operating cash flow to reinvest in the business. If a business is just focused in Canada and is not generating operating cash flow, there's something wrong.
Gotcha. Okay, great. Yeah, thank you for answering the questions. I will pass it over to Matthew, and we'll jump back in towards the end if we have time for audience Q&A. Matthew, go ahead.
All right, thanks, Adam. So I'd like to touch a bit more on the product side, especially you always mention quality as a way to describe the Cannara products. I mean, I think as a generalist investor, I initially struggled to really understand what that means and what quality means. Every LP I speak to, they all say they sell quality products, and nobody says that they sell shitty products, So could you help us understand a little bit the quality aspect and how you maybe benchmark that, or why Cannara provides some of the best value in the market for the price?
Yeah. So quality all starts with your cultivation. So just being vertically integrated and owning that would be the first question. Do you own your grow or you don't own your grow? If you don't own your grow, then sure, you might have quality today, but you may not have quality tomorrow. So the first question is, do you own your grow? If you own your grow, then you can confidently stamp the quality, or at least say that you have some quality, and then you would further look into the quality of the grow. And the quality of the grow really comes down to two things. The cultivation process. So down to how long you're running how well you're running your plants. If you're following the VPD charts to make sure that you're really stressing your plants and getting the highest amount of THC, the highest amount of terpenes, So really getting that quality plant. Then the post-harvest process of hang drying versus wet drying, or what trimming before you dry, and then track drying. That would degrade the product right away. So we do hang drying, which takes 14 days and a lot of capacity space, like these big rooms that we have to build out just to roll in some weed in there and stay there for 14 days. The other process is you could put it in trays and put probably 10 times more cannabis in a room on trays and dry it in 3 days versus 14 days. So yeah, you can really reduce your operational time and cost. But at the other side of it is the quality. It's night and day. Hand trimming versus machine trimming. We have a room with close to 150 people hand trimming all the weed that we have versus just taking all that and putting into a machine and trimming all that weed, which is significantly cheaper. But the quality output between machine trimmed and hand trim is night and day. And the customer can really see that from the look of the product. You can imagine if you took a flower and you carefully, delicately took off all the excess flour that you don't want on it versus taking the flour and putting into a machine that has scissors and rotating it and cutting it all up, what your end product would be. So investing in the or control, really being inside the cultivation cycle, the post-harvest cycle, there's many steps to maintain the quality. And then genetics. You have to invest in your pheno hunt program. You have to find these genetics. What does genetic mean? Imagine we were tomato farmers, right? And you had a San Rafael tomato, and that was farmers growing that tomato for the past 20 years. In cannabis, that San Rafael tomato, which is that genetic specific that gives that flavor of that tomato, the customer wants a new tomato every 3 months, a new flavor, a new experience. So we as cultivators have to be on top of that trend. We have to plant a bunch of genetic tomatoes and find a tomato that tastes like a blueberry and a tomato that tastes like onions and all these different flavors. And they have to grow well, and they have to have the high THC, and they have to have all the benchmarks. And that one takes room, right? You have to do that on a commercial basis. You have to carve out rooms that would otherwise generate revenue. You have to carve that out and do research and development in. And that research and development doesn't take a day or 2 days. It takes 12 to 14 months to find a genetic. So you have to do that while building this whole cultivation system and turning out this and R&Ding, and then, okay, we have to find a new flavor and get that new flavor in the system and all that stuff. So, doing that work and that R&D and building that IP around genetics is extremely important to differentiate your quality. It's like as if Cannara was going to Walmart and buying tomato seeds and selling you Walmart-based tomato seeds versus going and creating our own, genetically modified tomatoes with all these flavors and creating a product IP out of that. And that's what we're doing with our genetics. The cultivation cycle, like I said, from the flowers to the post-harvest and all that. And then it comes down to the branding, the packaging, the detail of the packaging. Like we think about everything. Let's say for our vape cart packaging, most LPs will put it in a cardboard box that has no customer experience when opening it. You have to rip it apart. Once it's open, the vape cart, you don't have a place to put it. For Tribal, we have this beautiful tin case that you open it up, it pops up. You can open it with one hand so that you can have your cartridge holding your battery on the other side. It has slots for three other vape carts so that you can have your flavors and the transporting case. So we think of all, like, just beyond the product, we think of all the steps to improve the customer experience. And then the last piece of that is, the culture. There's a lot of culture in cannabis. There's a lot of followers and fans and influencers, and you have to basically become part of that community, which will get, it's not 80% of customers that are there, call it the 20%, but the 20% influences the 80% in our industry, right? So that's the whole kind of strategy for Cannara.
Oh, that's great. It seems like there's a lot of thought that go into the whole process. Can you expand a little bit on the pheno hunting process? Because I think it's a fascinating area of the business that I mean you touched on it a little bit, but can you expand on how you go about all that pheno hunting process?
Yeah, so I mean, it generally starts by sourcing seeds, and you source seeds from different breeders that say this seed is going to taste like this, and going to do that, and this seed is going to do this and that, and all these random names and all that stuff, because there's no, at this point in time, maybe in 10 years from now, there'll be a group that's R&D'd and figured out genetics and can say this seed's going to taste like blueberries, and you plant it and it does it. Right now, we're still learning about genetics, so it's a lot of trial and error. It's a lot of understanding where the lineage of that genetic came from, and then getting the seed and planting it. So we start by saying, okay, well, we do it 4 times per year. We usually have a flavor profile that we're looking for, so blueberries or grapes or some flavor profile. We source a bunch of seeds with our partner as well to get that. It's about call it 250 seeds, so 250 plants. When you plant the seed in cannabis, and I'm going to go into details, tell me if you're not, for me, just step out of that. But when you plant the seed, you can't just plant the seed and then let that grow it's a 4-month growth cycle. Grow, because if you plant it and you grow it and you get great stuff, you won't have that genetic anymore, right? Because it went into flower mode and you can't recreate it. To recreate it, you have to recreate a plant in cannabis, you have to not let it go to flower, which basically what that means is that you have to keep lights on it for 24 hours a day. If you shut off the lights, it'll start changing its photosynthesis period, and will start telling you that it needs to generate flowers. So what we have to do is plant those seeds for 3 to 4 months and make what we call mother plants. And these are plants in a room. So now this is another separate room where you're holding 250 different plants that have 24-hour lights on them, and you're waiting 3-4 months so that they can grow big plants, so that you can start taking clippings of them to start your actual pheno hunt process. The reason why is that when you start the pheno hunt process and we find something that we like, then we can go back into our mother room, say, okay, that's the one that we want. We replicate the mother, and then we can go commercial. So we have 4 months of creating the mothers. Then now we have to create a first trial test, which is rooms that we would carve out, 2 rooms that we would carve out at our Farnham facility. And we'd plant all these 250 genetics. We'd wait 3 to 4 months for them to grow out. We would harvest them and then do a sensory test. So this goes through check boxes for yields, THCs, terpene levels, and then actual sensory tests by our sensory panel, and then as well as myself. Basically narrow it down to from 250 genetics. I'm lucky if I have 5 that I can say, you know what, these have something. Once we narrow it down to the 5, we can't go commercial because we have to test if we only planted 1 plant. So you need to know before you plant 10,000 plants, we want to do an interim testing period. So out of the 5 ones that we choose, now we run 200 plants of each of the 5. And then from there, we basically wait another 4 or 5 months, do another sensory, make sure all the check boxes take the same way or if not better. And then once we narrow it down, we figured out the terp profile, we figure out the whole image of that genetic, then we decide to launch it into one of our brands. And even at that point, we can't launch it because now we need a commercial lot. So now we have to make the commercial lot, which is now 4 or 5 months period from that point on to make the commercial lot.
Well, that's pretty sophisticated process. That's very interesting. Can you, if we talk a little bit more about the operations, the cultivation, you recently announced that as part of your last earnings press releases that you were able to increase the yield and productivity at Valleyfield by 25%. Can you go into a bit more details on how you were able to achieve that?
Yeah. So the original plan was we had 12 rooms. We had about 40,000 tons with the 12 rooms. The really what dictates one is or the output, the annual capacity. One is number of plants inside your room, which we didn't change. Two is the number of grams each plant makes, which changes every quarter. And as we pheno hunt new genetics, like when you, and that's why pheno hunting is so important. I could pheno hunt something that gives me 60 grams per plant, and I can pheno hunt something that gives me 110 grams per plant. You can imagine what that does on my cost per gram, right? So the goal is to find all these phenos that have these super high yields. So we have density, which we didn't change. We have yields, which we always look to increase, and you can see the trend quarter over quarter increasing. Then you have time. Because of a cycle time, that 4 months, 5 months that I was speaking of, you can only churn an X amount of rooms per year. So during our original cultivation process, we kept them on longer during like in the rooms. Through R&D, we discovered that during a certain phase of the cultivation cycle, we didn't need to keep them as long as we needed to, shaving off 6-7 days off of our total cultivation cycle, which changed our churning of our rooms from 4.5 to 5.2 times per year, which allowed us to scale from 40 tons to 50 tons with the exact same 12 rooms. The initial plan was to, and why the total number of 100 didn't change was as we got to call it rooms 15, 16 in our plan, we were going to turn on our rooftop greenhouse to do the vegetative cycle or part of the cycle up in the rooftop greenhouse, which would save the same amount of days to get the same amount of kilos. Now what we did is that we figured out we don't even need the rooftop greenhouse. We can achieve that full thing. So we're still maintaining our 100,000 kilograms, and now that's just the main greenhouse. There's an opportunity for the rooftop greenhouse to generate additional biomass material, but it would be biomass material, and we're waiting to see where the industry would be in 3-4 years from now for that.
So ultimately, the rooftop could provide additional capacity, but it's to be determined at this point.
Yeah, exactly. So before it was going to be used for vegetative process. Now it's not part of the plan and additional capacity for us.
Okay. So the capex plans change a little bit. In next year you were supposed to open up a few more rooms. Instead, you're building the new processing center. Have you started to make those investments on the processing center? And if not, what's kind of the timeline we should expect?
It's 2026, so we're going to start it in September and probably end it around June, July. And then we'd be ready to activate rooms 1, 2, and 3, or 13, 14, 15 from that point on, which to turn on those rooms takes about a month or 2.
So in the meantime, you have enough processing facility in Farnham to
the original
reach.
time it was 50. We could the Farnham capacity was 50,000 tons, so that's why we were going to turn on the 3 rooms and then go to the processing center. But because of the change, we didn't need. We got it with saving the 3 rooms, so now we have to invest in the processing center and then we go back to the 12 rooms.
Okay, so fiscal 2026, you build out the processing center and then you're ready to scale up again in 27 and beyond.
Right.
Okay, perfect. So the capex that you spent so far this year, I think you were close to $5 million in capex this year. Did you prepay some of that so maybe some of those equipments for the processing center, where it's all on the rooms you currently have?
Yeah, so that's the rooms 11 and 12 that we turned on. We also invested, which is spent in the quarter, on the electrical loop to turn on the electricity for the east side, so the 12 rooms. So that's because in order to turn on the 12 rooms, we needed power to the 12 rooms. So we built the power. Now we're building the processing center. That was the longest. It took 4 or 5 months to build the power. And so that when we're done with the processing center, we can just go right into the cultivation rooms and start building them out and not waiting for the power hookup. So big, I believe it was like a $2 million spend for the power hookup. And then a lot of automation equipment. We got a bunch of new machines in the year to help us expand on pre-roll manufacturing and packaging.
Okay, so you're laying the groundwork for the next phase of scaling, essentially. Okay, perfect. Can you tell the story of how you were able to acquire the Valleyfield facility for 10 cents on the dollar?
The stars aligned. uh, it was so. I mean, it was 2021. We we literally just launched Tribal and Nugs into Quebec, the only province. We still had Farnham facility. Um, I remember launching in Quebec, and we were selling out like every day, just Quebec, all our stock. We had memes, people running out with cans. It was it was good times. But it was because of the value proposition and what we offered, and like no one was there at that point in the industry. Like we led that change to the industry. Um, and yeah, so we sorry, just repeat the question. I got off track right there.
So how were you able to acquire
Oh
Valleyfield
yeah,
for,
Battlefield. Yeah, yeah. So we were just selling so much that we kind of stood after like 3 months. The SQDC was asking for more and more and more. So we had to kind of decide very fast within 3 months of turning our operation online that we need to scale up. So we looked at our facility, which we had expansion. We had only 170,000 built out, but the rest of it was leased out to long term tenants. So we were going to scale into that. It was going to take an extra year to build out. Um, and this is, when I say the stars aligned, the stars did align because the timing was exactly when we needed it. And we got a phone call from BMO saying, there's a opportunity that a company is selling this 1 million square foot purpose built greenhouse, and it was perfect timing for us. And we looked at the deal. Two factors that we assessed to win the deal was we knew exactly how much debt was on the facility, $27 million to be exact. Um, so we knew what needed to get paid for the key decision makers to sell it or be forced to sell it. And then two, we had access to that capital through our through one of our directors, who's also one of the bigger shareholders in our facility. Sorry, in our company. We were able to drop the cash with 30 days, closing. Uh, no, like very minimal due diligence as is, because we were confident in the purchase. So it was a very strong offer to close fast. And then the third major thing is, which played to our advantage, is in order to acquire an agricultural asset here in Quebec, the purchaser needs to be 50% plus Quebec based. So the ownership structure has to be Quebecois to protect our agricultural industry here in Quebec.
so yeah,
50% plus Quebec. So we were the lucky winners.
that was a once in a lifetime opportunity, it
It
seems.
really, it really, really was.
And can you maybe there are two ways to think about it, but if you were to replicate this facility today, build it from scratch, given like you bought this or it was constructed many years ago, so given inflation in building costs and everything, how much would it cost to replicate this today? Or maybe the other way to think about this is if you were to sell the facility to another LP today, like
Two
do you have
different numbers.
any
Two
idea how
different
much it would
numbers.
be worth?
Yeah, two different numbers. Just because I think the industry is not there. Like the LPs are not there yet to really give the fair value of the properties. The industry is not there yet. They requires real operators like ourselves to take the value of the industry of the facility. But I mean, to rebuild this thing today is easily over 350 million.
Okay. No, that's because that was part of my thesis initially. I mean, still is, but I think there's a big margin of safety in terms of the assets that you own. So this
Yeah, like
facility,
ultra like liquidated value. I think we're at a like this is like selling it to turn into flowers or something like that is like $100 million or something like that.
and you have Farnham on top, which
Barnum,
is
which we
where,
completely own, which is just on the capex rate, you're 60-70 million dollars just on like not cannabis, like just to rent it out. Yeah, like 60-70. So just between the two assets, you have pretty much our market cap.
Yeah, exactly.
At a liquidated value too, not at a fair value.
Yeah, yeah, exactly. Okay. In terms of expanding outside of Quebec, I mean, obviously you've shown like you're really strong in Quebec. Sounds like even though you'll probably keep growing in Quebec with the vapes and everything you're doing, the large opportunity for you over the long term is, I think, in other provinces. You mentioned it's more of a CPG strategy in other provinces. So how do you adapt, and what's your strategy to attack those new markets?
So it's a slow and steady sales and marketing approach. It's identifying key accounts that we want to operate in, negotiating with them, partnering with them. Ultimately, we have products that customers want, so it's a matter of just creating beneficial partnerships with retailers to get that, and not all around money and data fees and all that stuff. So we're trying different strategies to gain market share without having to invest in those data fees, and working with key accounts to do that. Our sales team, we're 5 people across Canada, for $120 million of $105 million of net revenue. So we have the ability to scale our team. We're choosing the right markets to do it. We have no trade display programs. Really, we're just starting to build that out. So when you walk into a store, they're at the cash and things that, like, you don't have those trade displays and promotions that everyone else is doing. Buy 3 pre-rolls, get 1 free. Like, we don't do any of that. So it's about building those promotions, building our key accounts, and just growing with that. And ultimately, the bigger, larger retailers, we have what they want, right? We have cannabis, good quality cannabis, right? And they need to sell quality cannabis, not only to their customers and all that, but they want to, the retailers, if you look at their strategy, they're trying to white label cannabis so that they can sell into their stores. They're trying to go international to sell cannabis so that they can get additional revenue to invest in Canada. So we have what they want. It's just a matter of, building that partnership and figure out where it's a win-win for both of us. And that time will come. It's just, doing it in a steady approach.
Okay. Just I'd like to touch on the international opportunity because it's been a big topic in Canadian cannabis recently. A lot of LPs have pivoted to selling internationally because you're not subject to excise tax. Prices seem to be higher from what I'm hearing. So international sales currently seem to be more profitable. So why don't you take advantage of this opportunity given the unused capacity that you have at Valleyfield?
Yeah, so it's short term. I think it's short term growth. I don't think it's going to be sustainable. International. Name me one industry where 100% of the of the industry in that country is imported. So I think over time, tariffs, internal business development within that country will limit the opportunities. Plus, international is like the new thing, right? All the competitors are running in there. It's going to be highly competitive. It's a race to the bottom. We feel like everyone's kind of maximized Canada, and now they have to go international, and like we're just starting Canada, so we don't want to derail our focus. In cannabis, you need to be laser focused because of what I just said, at the cultivation and finding different tomatoes and blah 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 blah. You have to be laser focused on your operation. So like we can't even grow more cannabis right now. We need a year to build out a processing center, and then when I build out my processing center, do I turn on 1 or 2 rooms for Canadian cannabis, or do I turn on 1 or 2 rooms for international? And the problem with that juggling is that I sell to the government, which is, maybe I didn't clearly mention that, but I sell to the government, so all my receivables are collectible, payable, no collection risk. international, it's a crazy show for cash flow. So I'm very happy that I sell to the government and I get the cash, but at the same time, I got to make sure I commit and deliver on every level to the government. When they place an order, if they ask one day it's 1,000 units and the next day it's 20,000 units, because one of my sales guys did push a good button, but I sold that product internationally, I just screwed the Canadian opportunity. I have potential delisting because I can't satisfy the increased volume, and I lose that strategic focus, right? So that's what's always in the back of my mind is like, yeah, we can go international, maybe we can turn on 1-2 rooms, but what if I need that one room in a month because like something happened, right? So for us, it's, I know I'm leaving money on the table, but I'd rather look at international as a backup plan as we scale. Okay, if we have excess capacity here, and then okay, I can move a couple of kilos to international, but to open a room specifically for international, it's not something that I would consider. Yeah, opening a room for a partner that works on the other side, on the retail side potentially, but for international, I think we have to stay laser focused for Canada. Let all the other ones play in international and defocus themselves, and we're gonna leave a little bit of money on the table today, but it's gonna be worth it for tomorrow.
Okay, that makes a lot of sense. I think we're bumping against the hour, so I'll pass it back to Adam for I think closing remarks.
Yeah, thank you very much. Thanks, Matthew. Thanks, Nick. Really comprehensive overview. That seems like a good place to wrap up for today. We really appreciate your time, Nick. Thanks for all the detail about the business and for going through the presentation. Matthew, thanks for your time as well. As a reminder, we will distribute the recording on YouTube once it's available, and we really appreciate you participating. Thank you.
Thank you, Adam. Thank you,
Thanks,
Matthew.
Adam.
Thanks a lot. Have a good one.
You too.